Hello everyone, welcome. Happy New Year for anyone that I haven't seen before and it wasn't here in our last week's webinars. Happy New Year again. So trailing stops it is today. Hopefully you enjoy it. I'm sure that there are a lot of people that they are not familiar with trailing stops, but to be honest, I find it like that it saves you from a lot of hassle. And it saves time as well with you and locking profits. So consider these two things for me are just a must. So, okay, as I said, it's all about trailing stops, how to use them. But before, we're gonna do a small intro just to make sure that everyone is familiar with what is a stop, why it's needed, in general stop, what is a stop, why it's needed, what kind of markets we have, and according to each market type, how we can use our stop, when we should use a trailing stop, when we should not use a trailing stop, and so on and so forth. So this is in briefly what we're gonna cover today. Before I actually start presenting the webinar, I would like a quick someone quickly to let me know whether you can see my screen, guys. You can hear me loud and clear, and so on and so forth. The things that I keep asking every single time, just to make sure that everyone is with me. Okay. I need to upload the PDF. I try it before and it failed for a reason. Let me try again now. Yep. So PDF is on. So this time Andrea didn't forget. This recording is recorded. This webinar is recorded, so don't worry, you're gonna have the video afterwards. So we are good to go. Thank you, John. Thank you, Jerry. Thank you, Adenyi. I'm glad that you are here once again. This is the email address. Feel free to use it. I'm here to help. So let's go through the disclaimer warning. It's a must as well, fortunately. This material provides a general market communication for information purposes only and does not constitute independent investment research. Nothing in this communication is contained or should be considered as containing an investment advice or an investment recommendation or solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. You can find our full risk disclosure on our website, along with other legal documents that you might need. And we are good to go. Hello, Michael. Hello. So, guys, a quick briefing, just because occasionally we have new people here that they have just joined the Forex industry, newbies, not even traders sometimes. So, briefing: what is a price action? What is a mean reversion? Before we go through the stops, we also go through. I'll try to help you actually identify where to place stops in order to avoid get them triggered before big moves. Of course, we're gonna see what is a stop first of all, why it is used, then be more specific, checking what is a trailing stop, how to set it, things that you have to keep in mind, when you should use it, when you should not use it, some advanced trailing stops in your trading as well. What I mean advanced, how you will be able using either ATR or other setups to take it a step upwards. And if we have the time, we might also see how to calculate position size. That was just as a bonus. But if we cover the 7 out of 8, I'm sure that you will be I will be more than happy, because this was just an extra thing um, that I had added. So first of all, just for newbies to clarify that in the currency trading, in general in the trading, I should specify over here, not solely in the currency trading, but generally in trading, there are two types of strategies. There are two types of approaches, if you prefer. Price action, so following the price of the asset, the price movement. So it tends to be a quite powerful approach, because it's if you follow the overall trend, then you avoid any um, any how can I say it? Um, any short-term ups or downs. It's a bit tricky. It's not easy to be a trend trader, or in general to use a price action approach. Um, However, as I'm saying over here, identified it is a bit more difficult, as the trend needs to be fueled by news in order to carry serious weight. But if you spot a trend is our friend, then if you have identified a trend, you um, you can actually um, identify the direction of the trend, and by appropriate risk management, you can follow the trend and stay in the market despite some short-term some spikes or some sharp movements that might have caused by news. Okay, so it's a bit more tricky, but it's very powerful. A more common approach is a mean reversion, which is easier to be identified and can be profitable as well. So is anyone so just briefly, because I'm not sure whether anyone understands what I mean by mean reversion approach or strategy or process, but it has to um, it refers to the fact that if we see um, if the if there was an extreme price move in the market, okay, then you should know that the price tends to return to an average level. So traders who are actually following the mean reversion trading, they are using different approaches, different methods in order to enter the market on the prospect that the asset will return back to the average level. Okay. So they are really betting that an extreme level, whether it be volatility, price, growth, or a technical indicator, will eventually return to the average. So these are the two. So what I mean by that, okay, let me give you an example. Maybe, let me check something. Okay, dollar. Dollar is a good example lately. So, okay, here's our dollar. We have seen it. Okay, here we are. We have seen it steady sideways, like in a range since November, right? So, the so there are multiple ways to, of course, um, to have this mean reversion approach, but I'll okay, I will briefly say that okay, we have the dollar index is in a range, so the average value of dollar currently, based on the fact that it's trading for 2 months, nearly 2 months in a row within this range, is at the mid of the range. Okay, so the mid of the range is at 96.30. 96.26 more precisely. Okay, so I have identified the midpoint of this range. So this is our average level. So so if we have a sharp dip or a sharp rally retesting these two barriers but failing to break them, then what it usually is the case is that the asset will turn back to the average level, to the midpoint of the range. So in this case, it's 96.26. And this is what happened also. You can see it happening the last 2 months. So if this is a daily chart, I will zoom in to the 1-hour chart, and we can see that even though the asset, so can you see that? Even though we had a sharp sell of yesterday, right? With the asset bottoming at 95.60, sorry, 90, no, 95.70. Then after the sharp extreme decline, we have seen it rebounding and retesting the midpoint. So every extreme move, every extreme sell-off or a rally, the asset tends to turn back to the average value. Now, this was one example, but the mean of every asset can be represented by other ways as well. So a simple moving average can also represent the average price of the asset. Okay, so if we have in mind that we are a scalper, for example, okay, you might be a scalper and you are trading in 1-hour chart. So the mean average, the average price, the very, very short average price of your 1-hour chart dollar index, it will be shown from your short-term moving averages, such as the 5, for example, or a 9. So over here, we can see that the 5 and 9 are the mean of these assets in 1-hour chart. So depends on your time frame, on the approach that you use, and so on and so forth. So if I put the daily chart on, I zoom out a bit, for example, the 20-day moving average can also provide us the mean average of the price. So if you're a daily trader as well. So yeah, there are different strategies for mean aversion. I don't want to go through right now the mean aversion because it's all about trailing stops right now, okay? So let's move on. Again, just clarifying from newbies, ranging is the market in which the asset it's consolidating, is moving in a sideways movement, retesting again and again the same support and resistance levels. Okay, so and touches these barriers all the times and turns to the other direction. So here's we have a ranging market. So it's when it's stuck in a range. When we have a trending market, when there is a trend, when there is a clear direction, when we connect our lows and highs and they show it a direction. So by identifying dips or throats in trend in order to get the best price during a trend market. So Here we have an uptrend. By connecting the dips, we have identified our lower trend line, immediate support, or by connecting the highs, we can have the upper trend line, which is the immediate resistance level. So every time that it touches the lower line, we can say that, okay, we'll rebound to the upside. Or every time it retests the resistance and turning lower, we could say that it will get back down and retest the lower trend line. So it's when by connecting the dips or the throats, we have identified a direction, when there is actually a trend. This is when we have a trending market. So now let's go to the um, um, actual topic, which is about stops. Briefly, why are stops needed, right? So, oops, let me just check something. Okay, we're good. Okay, let's start. Stops. Why are stops needed? So, why are needed is something that we keep saying, guys. Stops is a way that if something happened, if anything happened, you will manage to eliminate the risk. Even if you do everything right, everything, you cannot, there is nothing to guarantee you that you will benefit. Why is that? Because there might be news, data news, there might be political news, there might be geopolitical news, there might be, I don't know, weather might also affect the markets. Something happened in the market might get turns against you. But so by having a stop loss in advance, it's a way to limitate as much as you can the risk of getting of blowing out your account. Is a way of sorry, I need to mute this. Okay, is a way to limit the risk and also to control any potential losses that you have. So by setting your stop loss, you are the one saying that, you know, in this entry, I don't want to risk all of my money. I want, if it turns against me, to lose only $5. So by setting a stop loss based on appropriate risk management, appropriate risk and reward level, you are the one that controls the risk, controls a potential loss in a case of a failure. Okay. Investors that are not using leverage have the privilege of not using tight stops, but leverage products such as in the Forex industry, the Forex market need special attentions because stops are there to prevent unnecessary large losses. So you are trading with leverage, okay? You have leverage positions. So stops, as I said, prevents you from unnecessary large losses because you are the one that you will place your stop loss away from your entry level, right? So you are in control of how much you want to lose if in case that something happens and the market turns against you. So they are needed. I know that the majority of you just enters the market without stop loss, without targets. I understand why you're doing that, but if you want to be serious and if you want to succeed eventually as a trader, then this is not the way. The way is risk management. It's the number one, is that it should be on your priorities, on your the top priority. If you want to succeed in the market, to succeed as a trader, then you need a business-like approach. So you need to manage your risk before entering the market. So stops are needed if you want to manage your risk. This is the only way, risk management. A person, a trader, an investor that hasn't done risk management, it won't succeed. It might succeed once, twice, but overall, at the end, it will suffer from losses rather than at the end to when he sums up everything to be on profit. He will definitely be on loss. Okay, it's like a normal business. Okay, it's like if you have a store and you're selling stuff. Okay, you need to do your business plan to see what the clients want, whether the clients prefer cheap stuff, they prefer expensive stuff, they prefer uh, quality stuff. It depends on your clientele. So you will base your supplies based on your business model in the clientele preferences. So you are doing an appropriate risk management as well, right? Your sales shouldn't be less than your expenses, right? So this is risk management. Don't risk more than what you can afford. So trading is, if you treat trading like your own business, which is your own business because you are risking your own money, so you need to um, treat to trading like you were about to treat any business that you were ready to open, a store, I don't know, a restaurant, anything. Okay, because it's obvious um, we cannot have more expenses than incomes, right? Incomes should be more than expenses. So for having a business, you need to make sure that you have an income that is greater than that cost. This is the requirement to run a business properly. The same stands for trading. Stopped traders are part of the day-to-day cost of running your trading businesses. So make sure the cost is small. Make sure that the stop loss is nearby. If there is no clearly defined strategy for using stops, it is difficult to evaluate and develop your trading as a whole. Okay, that's obvious. I have done many webinars, me and Stuart, going through strategies, presenting new strategies, going through how you could create your own strategy, how to write a journey, a trading journal. So without having a strategy, without at least identifying your preferable indicators, identify a setup that it's easy for you to understand, it's quick, it gives you nice indications, then you cannot really you cannot really open a position. It will be like a suicide. So you need a strategy, and a strategy also always contains target identification and stop loss identification. Otherwise, it will be too difficult. So, but challenges in choosing a stop loss is tricky. It's not easy to identify a stop loss, right? But that's why we have indicators, and we have so many tools, and we have if we didn't have the indicators that help us so much with the trading, but even if you don't have any indicators, or you do have but you prefer price action, you prefer to check your candles. Candles are there to help us identify support and resistance levels, so identifying our potential targets or stop loss level. Okay, but sometimes we are connection. The challenge that we face is whether we have set our stop loss too close and is more likely to get stopped out, or whether we have set our stop level too far. So it means either that the risk is too high and that the participation rate is too low. These are the key challenges that we have. But this depends also on the risk and reward ratio. Okay, so if you are if you have predetermined your risk and reward ratio and how much you want to spend how much you are willing to lose in case that it kicks your stop loss, then these challenges will have been avoided. Okay. So before I go through the trailing stop losses, just briefly, we're gonna go through normal stop loss with the help of ATR. Okay, it's just consider it as an intro or as a yeah, it's an intro before seeing the actual trading stop loss, just to put it as an extra. So I will make sure that I will give you an idea of a usual stop and how you can use your ATR indicator to set a stop loss, right? So okay, very, very briefly, the ATR is an indicator which which it actually aims um, to provide us an a, a value, okay, a value um, based on the based on the range, on the current range that the price has moved into the past 14 periods. Okay, so it's an absolute value, it's a true value based on based on the current on the recent range that the price has been moved. What I mean by that, so it was something that it was created by Wells Winter. Wells Winter is responsible for many indicators. He developed many indicators. Average true range is one of them, because he wanted to identify to develop an indicator that includes in the calculation the gaps as well, not only the bar ranges. So you know that sometimes we have seen gaps in the market. So for example, it closed over here, but the next session it opened higher. So we have gaps. So the majority of the indicators are not including gaps. So Wellers wanted to find the true range of the indicator, including the gaps, the true range of the price movement, including the gaps. So you see the true range in this movement is this one, So we including the gaps. So what we mean by true range is the highest of these true values. If we deduct the current high minus the current low, if we deduct the previous close from the current high, and if we deduct the previous close from the current low, the one that give us the one of these three that it give us the greatest level, the greatest number, this is considered to be the true range. So the calculation of ATR uses absolute values in order to avoid negative numbers. So these are absolute values, because it's not an indicator that shows us directions. It's an indicator that shows us distance. So once the true range is known, a moving average can be applied to it. Okay. So simply saying, okay, let's simplify a bit the things with ATR. What you should know is that ATR shows you with this calculation. You don't need to do this calculation, it's automatically given done for you. So, but what you should know is that ATR shows you how much an asset moves on average during a given time frame. So it shows you how many pips has actually moved on average. The average movement of the asset, if you are in a 1 hour chart, then is for the 1 hour time frame. If you are in a daily chart, is for the daily time frame, and so on and so forth. So it helps you to confirm when the Okay, it helps you to confirm you are to initiate a trade actually, and you can use it to place, you can use the number, the value of the average true range to place your stop loss order. Okay, so let me give you an example. So, what's my, oops, I closed my MT5. Okay, I will bring it back up. Come on, come on, come on. Okay, here it is. So, let me get rid of the others. So, okay. So, for example, so we have over here our ATR, suggesting and suggesting or actually stating that the that the dollar in average is moving by only 6 pips in this 1 hour chart. Okay, so that's why ATR is commonly used as an exit method, okay? Because by being aware that it moves on average by exit 6 pips, this means that if you decide to enter the market due to this rebound, okay, then you can place your stop loss 6 pips below the entry point. So that would be around here in this case, in the current, based on the current price movement. Okay, so it gives you how it tells you. Oops, why is not? Okay, yep. So it tells you that on average, in this 1 hour chart, the asset is moving by approximately in average by 6 pips. Okay, so ATR can be used as an exit method. Okay, either by setting your stop loss exactly on the based on the ATR value, or by multiple ATR values. So you are based on your risk and reward, you might consider that, okay, because my target is far away, I will set my ATR twice, my stop loss twice the ATR, so 612. So that means that it should be shifted down to here. So stop loss is here, and let's assume that, let me just check. And target is initially on the round 95 and oops, and on the upper range. Here we are. Okay, this is just briefly how you can use, just to get familiar actually with the ATR. Now, let's move on. Another approach, I have, by the way, I have an exclusive ATR webinar, so feel free to have a look. ATR, you can use also a percentage of it. So for example, over here, the asset was in range. So by identifying the upper line of the range, so the initial was 124.6 and the other resistance is at 124.80. So a long entry was taken as soon as the asset managed to break that resistance at 124.80. So a long position open on this breakout. Okay, so here we are. Oops, no. So a long position on the breakout of, this is 15 minutes chart, by the way, guys. Okay, on the breakout of the 124.80 level, long position. So we can see that the daily, in this case, the ATR, oh shit, I forgot to put it on. Okay, the ATR was suggesting 100 pips movement. Okay, so the daily ATR, this is a 15-minute chart, but by checking my daily chart, I noticed that daily chart is stating 100 pip movement. But because I want to trade intraday, I consider that I'm gonna use only the 20% of the daily ATR value. So 20% of 100 is, come on, come on, is 5 pips, okay? So 5 pips. So the, sorry, what I mean, 20%, oh my God, 20% of the 100 is 20. So that's why the stop loss was shifted. The stop loss was set 20 pips below the entry point, okay, and the target was set at the um, at the 125.50 level. So around 60 pips higher. So the risk and reward over here was 1, 2, 3. So risk and reward was 1. Oh, I'm not writing. 1, 2, 3. So 1, 2, 3. So risking 20 pips, but my target will be 60 pips if I hit my target. So I will gain triple of what I have risk. Okay, so that's how you can treat it. Also, you can combine multi-time frame analysis as well. I'm not gonna go through right now. I want to quickly shift to the trailing stops. So feel free to check these slides, okay? But by checking the ATR value of higher scales, it can help you identify multiple target areas as well. Okay, so by combining multi-time frame analysis, pivots, and ATR stops, you can create your own systematic strategy on placing stops, like we did in the previous example. So identify multiple support and resistance levels, identify that you have identified in a higher time frame, setting your trend line so you will be aware of the immediate support and resistance levels, put your stop loss behind the entry point using a percentage of your stop or either your ATR or the whole of your ATR. And once your ATR the asset moves lower than the ATR signal, then you can have your sell stop, or if your signal bar is higher, is high plus the ATR number, then you can have a buying stop. But I don't want to, okay, just ignore this for now, guys, because it's not about multiple time frame right now. It's about trailing stops. So I need to quickly move on until I shift to the to the trailing stop. So I will skip this, okay, for now, and if we have time, we can get back. So let's move on to trailing stops. Okay. Actually, no. Let's take it step by step as we did before. So, example, just to make you understand how you can use your ATR in a multiple time frame, using multiple time frame analysis as well. So, let's assume that we have this euro dollar chart. Okay, this is a 5 minutes chart, by the way. Okay, this is a 5 minutes chart. It was consolidating, right? So our immediate one of our immediate support levels of our floor was that one, 120.41. Okay, it broke it and it continued dipping lower, posting fresh lows. Okay, posting fresh lows. So having, however, before all this happened, doing your checking all the time scales. So we have noticed that in the 4-hour chart and the 1-hour chart, okay, that 1:20:32 in the 1-hour chart and 4-hour chart, it was an immediate intraday support level, okay, that was retested, but then the asset rebounded away from it. So that was a intraday based on the 1-hour and 4-hour chart. That was an immediate support level, okay. Eventually, since you need to put your if you find intraday support and resistance levels, you need to put these your trend lines on so you can stick, you can have them drawn. Okay, so that let's assume that that was the intraday support based on the 1-hour analysis and the 4-hour analysis. So once you have identified intraday support and resistance levels, such as these three, you can then go to the time zone that you want. In this case, it's a 5-minute chart. You might have let's assume that I'm a scalper. I like trading a 5-minute chart because it's quick and etc. So having set this line based on my 1-hour analysis, I can go back to my 5-minute chart and wait to see whether the asset will manage to drop and to break that level. Indeed, it managed to break it over here, and the next candle was also negative. So it was a it was actually a signal that there will be further decline. However, further decline in a 5-minute chart. Okay, you need to stick to the time frame that you have seen. You have seen triggering your level. So you can use, as we said, either the full ATR or a percentage of it in order to determine your stop loss. Okay, so remember that the support based on the high time frame analysis was at 1:20:32. So the price retraced to a penetrated higher time frame support, which now has turned into resistance because it moved here and then it tried to recover, it didn't manage, and it turned back down again. So now it's 1:20:32. It has turned to somehow a resistance level. Okay, so that could have been your entry point on the penetration, okay, with the daily, by using 20% of the daily ATR as your stop loss, okay, and the risk and reward ratio for identifying your potential target to the downside. If you miss this opportunity, however, so let's assume, okay, let's assume that the ATR in the 1 hour chart shows us um, 16 pips movement average in the 1 hour chart. So you can either use the full of it or the half of it. If you're gonna trade on a 5-minute chart, you can use 20% of it or 50% of it to set your stop loss. So 50% of 16 pips is 8. So if we have taken an entry point, an entry level, an entry position at 120.32, and we are trading a short position, and we're in a short position, then the ATR will be 8 pips higher than entry point. So that 120.32 plus 8 is 120.2040. So I may have a type over here. It should be 2040. Okay. So stop loss at 120.40. So I had it correctly. If let's assume that we took ATR as well. Remember, ATR was 16 pips, right? Uh, um, so where is my calculator? You can use as your target area. You can identify your target area based on your risk and reward. So let's assume that since you have set your stop loss at 120.40, right? This is 8 pips away from the entry level, right? So the target could be placed 3 times the stop size. So 3 times 8 or 2 times is based upon your risk and reward ratio. 1 to 2 is a very wise and reasonable risk and reward ratio. 1 to 3 also okay, but be careful not to overdo it. So if we have 1 to 2, then means that if our entry point is 120.32, then plus 16 pips, then this implies um, to 124 sorry one because it's a short position 120.16 if we have taken as a 1 to 2 risk and reward ratio, so we set our target 16 pips away from the entry level. If now we have taken a risk and reward 1 to 3, so we need to multiply 3 times the stop size, so 8 multiplied by 3 is 24, so 24 pips lower. So 1.2032 minus 24 pips implies to 1 21 let me 120.08. So these are, you can have multiple targets. And now, if in case that you want to let me think a bit. So if you are considering higher risk and reward ratio, and let's assume, like in the example here, you actually consider to set um, your stop loss. So your stop loss more than 3 times, nearly 4 times your ATR, then the next target area could have been the 119.80. Okay, so now let's move on finally to the trailing stops. We have explained what stops are, why they are useful, why they should be used, and etc. Trailing stop is a stop. Okay, it's a stop loss, but the good thing about trailing stop is that it gives us some kind of automation. So what I mean, in its core, a trailing stop is a stop loss that is not set to a single pip or dollar amount. Remember what we have seen earlier with the example is how to set the stop loss that is fixed, is at a particular level, right, for our entry. But trailing stop is not a fixed level. It is actually a fixed distance from our current price market. So it moves dynamically with the current market price in the same direction. So with a trailing stop, we don't really identify a particular level that we're going to use as our stop loss, but we identify how far away from our current price movement we want the stop loss to be. So a trailing stop, it is set and moves at a certain pip or dollar amount away from the market price, or is configured to stop you out of a trade when the asset price drops at a certain percentage. For example, okay, let's put all the lines on. Perfect. Oops. Yeah, perfect. So, for example, over here we are in an uptrend. In an uptrend, a trailing stop, in an uptrend, a trailing stop is a sell order, okay, that trails or tracks the price at a certain distance from the current price, okay? So let's see first the uptrend. So here we have an uptrend, right? So the price is moving higher and higher. The trailing stop is the price is dragging the trailing stop along with it. So we can see that the trailing stop is moving along with the price action, right? However, you can see that. So here is, let's assume is the entry level. The trailing stop was set over here, so having this distance. As the asset was moving higher and higher, the same distance, the trailing stop was moving in the same direction with the price, holding this distance that we have set in advance, okay? Holding this distance, holding this distance, holding this distance, and so on and so forth. However, when the price stops going up, but instead is keep going down, the stop loss remains at the level it was dragged to. So it was over here when the price was here, but then the price was starting moving down. So stop loss stuck over here. So since it's keep falling, then the stop will be automatically kicked. So it will be automatically stop. So a stop loss is more flexible than a fixed stop loss order because it might automatically tracks the price direction, and you don't have to manually reset your stop loss. Um, um, but similar to all the stop orders, a trailing stop enforces training discipline by taking the emotion out of the sell decision, and this is enable us as traders to protect our profit and investment capital. So what I mean, it was moving along with the trend, but if the asset stops moving higher and in case it's coming against us, the stop loss remains where it was initially, okay, where it was at the very last movement in order the asset to the position to close. With this way, we have gained all this, okay, because we have set our stop loss, so we locked all these profits before the uptrend reversed. Okay. In a downtrend, it's the vice versa. The trailing stop is a buying order that follows the price as the market moves lower. But as soon as the price stops moving lower and instead is starting going up, the stop loss remains at the level it was dragged to until the position closes. So the the positive, the advantage of having a trailing stop is that a traditional trailing stop follows the price at a set distance and is therefore vulnerable to early stop out due to price swings. But we have also advanced trailing stops. What we mean by advanced trailing stops. So in MT4, so let's have a look. Let's assume that I have opened a position, okay? Oops. Sorry, it's a demo account, so okay. Let me get rid of all this. So let's assume that I have opened a position. Can I? Because it's a, wait a minute, sorry guys. It's a new, sorry, it's a new demo account in MT5, which I'm not familiar with. So yeah, I don't have, okay. Let's try MT4 because I haven't put money in this demo account. Come on, come on, come on. Okay, I cannot really demonstrate properly as I want because it's a demo account, so I don't have any money in there. I haven't asked from the support team to top it up so I could demonstrate my mistake. But how you can set a trailing stop is open your position with a stop loss, with a target, okay? Are you with me? Open the position. Once you do, go to your trades, right click on it and click modification. And if you click modification, you can see that there is modification of having a trailing stop. So open the position, right click on the trade, click modify trade and add trailing stop. You can have trailing stop either having set like a particular pip number away from the price action, let's say 10 pips, 30 pips, 50 pips, or in dollar way, saying that, okay, I want to be $5 away. So if you lose money, you're gonna lose that that amount that you have predetermined. So you can either set a trailing stop based on a dollar amount or a pip amount. Also, let me check whether I can demonstrate in a different way. Um, Come on. I might be able to show it to you in a different way. Come on, come on. Here it is. Okay, I've managed to find it, so I can be able to help you. So you see, let's assume that you have positions open. So you need to right click on your toolbox, right click on the trade, on the open trade that you have. Over here, use trailing stop. I don't use these ones, the predetermined, but you can use a predetermined, or click custom. Okay, and by clicking custom, you can set your trailing stop exactly on the amount that you want it, on the pips away, on the how many pips away you want it. Not necessarily have this predetermined. You might want 15 pips, not 20. You might want 47. So you can amend it accordingly. Okay. Now, in MT5, if I'm not mistaken, there are also the option to have a trailing stop not per pip, but per dollars, per amount. For those that are using trailing stops, then you have this option. Okay, guys? So, so you can, for each open position or pending order that you have, you can use trailing stops. Okay? Um, so what else about trailing stops? What else? What else? What else? I think that was pretty much it. Something that I forgot to mention is, other than the ATR, you can use the parabolic SAR as your trailing stop. So depending on where your parabolic SAR is, you can use it as a trailing stop. So it is often the case that the indicator can be used as trailing stop line. So if I apply parabolic SAR, let me demonstrate a bit. Actually, my parabolic SAR is over here. Perfect. So you see, I have my parabolic SAR. So if I was about to, so parabolic SAR right now is below the trade. Okay, I wouldn't take an entry right now because it's a bit mixed. It was, parabolic SAR was pressuring the price to move lower, but now it turned down. Something that is a bullish signal, but at the same time we have negative bearish candles. So if I was about to trade right now, I wouldn't take the entry because there is nothing clear yet. But just for the future, to be aware how you can trade how you can use your parabolic SAR as trailing stops. Assume that we had this upwards trend over here, and then we have a flip with this full body bearish candle, right? And on the next session, we had another negative candle, and eventually the parabolic SAR turned upwards, something that is a bearish movement. So if you were about to take an entry on this to the downside because the price started reversing and the parabolic SAR also turned bearish, then you can use the parabolic SARs as your trailing stop line. Okay? So you can use your parabolic SAR, you can measure the distance of the price from the parabolic SAR, okay? So 20 pips it is, and use it, set stop loss as based on the 20 pips movement, on the 20 pips distance that the price has from the parabolic SAR, okay? So this is another way. Now, so, oops, here it is. So a more advanced trailing stops. What do we mean by more advanced trailing stops? More advanced trailing stops is when you use your trailing stop at pivot points. So pivot points are considered to be the some support and resistance levels, right? In the market, in the MT4, we have a pivot point indicator. You don't need to, that is an indicator identifying pivot points. Where it's in, where's my pivot? Sorry guys, give me a second. No. I have it on my MT4. Okay, guys, there is a tool, pivot point indicator. You can download it from our website. I taught you that a million times. So if you go to the Hot Forex, going to the premium tools. So here we are, tools, premium tools. Where is premium tools? Come on. What's it, sites? Oh yeah, here it is. I was blinded. Premium trader tools. Go down to the indicator package, and you can download the pivot points. Here it is, pivot points. By download the whole package, you're getting pivot points. So with pivot points, you're getting the immediate support and resistance levels. Like that. Let me share my MT4 so you can see how they look like. So if I share, so I think you can see it right now. These lines, S1, S2, S3, PP, R1, R1, S2, are the pivot points that you can automatically get from the pivot point analysis that we offer for free. Now, by using these stop and resistance levels, let's get back to where we have been. You can set your trailing stops behind the pivot level. So by setting stop loss manually behind the pivot points, we can achieve to decrease the number of trades that they are stopped out too early. Okay? So every time your pivot high is penetrated, you can place a stop below the latest pivot low. So what I mean, so we had an uptrend, the price was moving higher, so we decided to enter long, okay, to take a long entry. And we have seen that the asset posted a high, but then it retraced away from it. So it penetrated, posting a latest high. Okay. Okay. And then it went down, corrected slightly, and continued the upwards move. So every time that we have in an uptrend, a pivot low, you can enter the market with multiple entries, or if you don't want to add multiple entries, you can shift your trailing stop below the pivot low, the latest pivot low. So you see, next pivot high, next pivot low over here. So we can set our drag and drop our stop loss on the latest pivot low. It was up, down, latest pivot low. So shift our trailing stop to the latest pivot low, and so on and so forth. So this is a more advanced way to amend your trailing stop. So you're setting your stop loss like we said, by modifying and come on, I showed it earlier. Where was it? Over here, by modifying, choose trailing stop, custom, setting in advance setting your stop loss, but afterwards every single pivot low that you get, you can amend the trailing stop in order to be exactly below the pivot low. Now, what else? Or again, you can use your ATR, the same ATR, the same way we use ATR before in a normal stop loss. You can either, let's get back to the MT4, MT5 again. So we said over here, we set the stop loss, the fixed stop loss twice the ATR. We didn't went to a higher time frame. We sticking to the 1 hour chart. ATR was pointing to 6 pips movement. So we have put the asset twice the twice the ATR. So if you remember when I was initially demonstrated, we have put it over here to be exactly 12 pips below the current price because it was 6 back then, 6 pip ATR. So you can use ATR as a trailing stop as well. So okay, if you're deciding that you want to enter long on this ring bound on dollar, you are entering long, then okay, ATR is at 7. So open the position, set your target, and then modify and set your trailing stop 7 pips away from the asset. So the trailing stop over here says 7 points. Okay, 7 points, because as I just show, if we're about to take a long position for a dollar index, the ATR says 7. So you will either decide based on your risk and reward ratio to use either the full ATR or half of it. The full of it is 7 pips, so your stop loss should be somewhere around here if you're gonna use the full of it, or if you're gonna use the multiple of it, because we're in a very short time frame. So 7 multiplied by 2 is 14 pips. So 14 pips, it should be somewhere here. So very, very close to our parabolic SAR. So that looks a nice stop loss. I will get rid of the other one. It looks too tight. So you need to criticize yourselves, guys, okay? Because if I use the full of ATR, the 7 pips, it looks too tight in the 1 hour chart. If I use twice the ATR, it looks nice and it consolidates with and clashes with parabolic SAR. So that gives me more trust on my stop loss that is in an appropriate level. So over here so the target should be based on your risk and reward ratio as well. Okay. And what else? Yeah. Now, if you are using, as we said, if you want to trade in a 5 minutes chart, okay, you can do the other approach that we demonstrated. You can check the ATR in the 1 hour chart. So ATR is 7 pips. Okay, our immediate support level is this one because it was the latest high. Our immediate resistance support level, it was that one because it's our latest low. So we have found immediate support in the resistance area. ATR says 7 pips. So if you want to go down to the 5 minutes chart to identify a breakout of these immediate support and resistance levels, then in case that you see the asset breaking the 95, 92, you can go long, and as stop loss, you can use a percentage of your ATR in this 1 hour chart. The ATR in the 1 hour chart was saying 7%. So you can use the 50% of it or the 20% of it, depends on your risk and reward ratio. So let's assume that the asset breaks that level. the 95.60. Okay, let's assume that it breaks this level. Okay, so the ATR was saying the 1 hour ATR was at 7 pips. So if we used half of it, it will be at 3.5. So the stop loss should be somewhere, it should be 3 pips lower, should be here. If the asset breaks this level, okay? So stop loss should be, trailing stop loss should be 3 pips lower. Now, if we are deciding to use the 20% of 7 pips, then it will be even tighter, okay? So it will be at nearly 2 pips. So it will be somewhere here. In case that we open a long position on the breakout of 95.20. So again, you can use either a higher time frame and use a percentage of it, or why not? If you want to simplify stuff, guys, you don't necessarily need to use the hourly ATR in order to trade in a 5 minutes chart. You can use the 5-minute ATR. So the 5-minute ATR suggests 3 pips movement. So once the asset breaks the immediate support and resistance levels that we have identified, you can use as your trailing stop you can use for a trailing stop the 5-minute ATR, which it says 3 pips movement. So if you are going long, the trailing stop should be 3 pips below the price. If you are going short, in case that the asset breaks the 95.81 level, then you can use as trailing stop 3 pips above the entry level. Okay? Are we okay so far? I need to call it a day, unfortunately. This is another example of entry of price movement and long entry and how the stop loss moved, the trailing stop loss that we have set moved. So you can see the whole performance of the trailing stop as it was moving along with the price movement. So I have demonstrated how you can set your stop loss, so we don't need to go through this. Here is another example, intraday example of using 6-minute chart for identifying a trend and then waiting for a signal in a 5-minute chart and trading in a 5-minute chart. So having observed the 1 hour, identifying support and resistance levels, identify the direction of the trend, going down to the 5-minute chart and wait for these immediate support and resistance levels to break. And as soon as they break, to enter in this case to enter long with trailing stop at 3 pips away from the entry, okay, which anyway it was the distance between the entry level and the pivot high. Okay, it was just 3 pips away from every single pivot high that we are getting. Pivot high, pivot high, pivot high, and so on and so forth. So the ATR in the 1 hour chart was pointing to 23 pips. The ATR multiplier was stating at 0.3 pips distance between stop and pivot high. So by measuring the by sorry, by considering either 20% of the hourly ATR or by using the 5-minute ATR, we have set the trailing stop 3 pips above each pivot high that we were getting, and we were shifting it and shifting it out, or let it automatically at at either 3 pips above the pivot high or at 7 pips away from the current price. So that's it, guys. I need to call it a day. It is taking too long, so will finish by saying when it should be used and when it shouldn't be used. If you are considering to, if you are on, if you are a serious trader and you want to limit your losses to lock your profits, then you should use your trail. You should use first of all stop loss, but trailing stop will save you from getting emotional. And in case that you face any electricity issues or you have a second job and you cannot be on your platform 24/7, also it saves time for you. Trailing stops, um, you can use trailing stop when you know that you will not be able to access your trailing platform, and also it's getting you away from your emotions. Okay. So if, for example, you're holding a position open, but there is upcoming news that is expected to be negative ones, that will give you fear, right? So you will thinking that, shall I close my position? They might blow my position if I don't close it now. No, don't think about that. If you have a trailing stop, you can keep your position open because you have a trailing stop. So the trailing stop can get you emotionally um, because you are emotionally attached. The trailing stop can save you from that, um, and also it can save from the volatility that this news release will um, could actually cause. This way you will allow you the stop loss to move higher should the price still rise before the news, but also protecting more of your earned profits. So it's something that you should consider, especially if you are if you're trading currency pairs, that they tend to be immediately impacted by news releases. Helps you control your emotions, right? Because we tend to, as humans beings, if we are afraid of something, we tend to modify our targets and our stop losses after we have taken the entry. So this is prohibited. This is something that you shouldn't do. But with trailing stop, you don't need to worry about moving the stop loss manually because it will automatically lock your profits for you. Also, when you are a long-term trader and aiming for large gains per trade, you are a monthly trader or weekly trader, trailing stop can be a very good tool if used correctly. So you need to be very careful if you are a monthly trader and you aim to use trailing stops, okay? Because it's a slower time scale, is a long term, it doesn't being affected by the noise in the market, so it's not so it's a very good tool, but you need to be careful not to set it too far away. Why not use a trailing stop? If you are a scalper, you are most likely aiming for smaller gains. If you are a scalper and you aim for very, very small gains per trade, uh, then in this scenario, trailing stop usually proves to be quite ineffective. Uh, okay, this is because in this situation, if you are aiming only small gains in a very, very short time frame, 1 minute chart, for example, if you set your trailing stop too close to the market price, even a slight, a small price fluctuation can trigger your trailing stop to move very, very close to the current price. And a small spike in the opposite direction can trigger the stop loss as well. So it's not so effective if you are in a 1 hour chart, a 1 minute chart, for a 1 minute chart, or when you're scalping in general. Also, if the asset is moving sideways, there is really not much room for the price to extensively move in one direction. Trailing stop can be used only in a trending market, because in a sideways movement, the asset bouncing between support and resistance. So you cannot use trailing stops. You will end up um, you will end up closing your position without any meaningful performance. So if you want to try and use trailing stop in a ranging market, you need to be prepared that you will earn a very, very, very small amount at the best possible scenario. So trailing stops are not uh, uh, used in a in a sideways movement, okay, in a ranging market. Guys, I need to call it a day. Unfortunately, I won't be able to go through the position size, okay? But we have seen it several times, and you have the slides as well, so you can have a look. And if you face any kind of problem, let me know. I would like to thank you for being here. Hopefully you enjoy it. If there is any question, anything that you want to ask, something that confused you, etc., please let me know. Or you can otherwise contact me at webinars@hotforex.com as usual, and I will reply ASAP. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. So I call it a date. Thank you very much for attending. Hope you're having a great day ahead, and I'll see you again tomorrow. Thank you, guys. Bye.